Hey guys, welcome to another edition of MagnaLibra Trading and Research, or MTR as we like to refer to it. Today's episode is going to be called Global Markets Adjust to Trump's Post-Liberation Day Tariffs. We just wanted to get this quick video out here, guys, as there's some important moves going on through the markets, and hopefully you guys are well informed from yesterday's data that we put out late in the day, and also back on April 1st. As you can see here from our MTR website here, on Substack. You can go to this and see all of our work and everything from that we prior videos, prior written content at the www.magnalibra.com. Make sure you put that www in there, guys, to get to the Substack that we write, because if you don't, it'll send you right to our magnalibra.com, which is for our commodity trading advisory. So make sure you put the www in there beforehand. You'll get you to this website here. Here's the content that we put out on April 1st, and here was yesterday's as reciprocal tariffs hammer stocks. But as always, quick disclaimer, let's just get into this first before we get into the rest of the podcast. This is obviously just for educational purposes only, not a solicitation to buy or sell commodity futures or options. Risk of trading securities, futures, and options can be substantial, may not be appropriate for all listeners. All right, guys, so that's what we put out here. We put a lot of content out, but both free and for our subscribers. We just want to make sure that you guys know where to go and get it. As far as yesterday, we put this out late. This was the down move as the markets reacted to Trump's reciprocal tariffs, as they're calling them. And so we put this out, and the initial part of this reciprocal tariffs hammer stocks post that we did is free content, so you guys can go in and read up most of that, and that's what we figured. We do most of the time here, guys, because our goal is to educate you. We want you to know what's going on in the world. As far as today, obviously the markets are reacting and adjusting, but we just wanted to share a little bit from Bloomberg surveillance. They had Howard Lutnick on. And it's Commerce Secretary talking about how are the other countries going to react. So let's listen in here, guys. We think this is important. And we think what he has to say is kind of telling of where the Trump administration policy is and where it will be and how they are and why they are doing what they're doing. So let's listen in here. Howard Lutnick here on Bloomberg Surveillance.
If we could just sit on the methodology just for a bit longer and address it directly. This is what we understand, what most people understand you did, that essentially you divided the country's trade surplus with the United States by the total exports and then divided the number by 2 and produced this discounted rate. If you're a trade partner right now and you've just watched how America has put together that policy, how are you meant to negotiate with that? What are those countries meant to say? What are they meant to do?
The countries understand that their trade policies were an exploitation of America. Everybody understands. One country actually said to me, I was amazed that we were able to get away with it for this long. I mean, imagine that.
Can you share that country with us? Because they don't say this, they never say this on the record. You've got the potential, the option, the ability right now to share that with us directly. Of course they're not going to say it on the record. Who's saying that to you?
No, come on. Oh, stop. I mean, the country, one country told us that they give the subsidy to the car companies. Another country admitted that they give their subsidy to their steel companies. I mean.
So that's, oh, stop. We love Howard Lutnick, and it's just his point blank response there. But he's right. This is something that's been a long time in the making, and we suspect that this is going to cause a lot of readjustment across the globe here, but we've warned about this, and we figure that there's going to be a long-term adjustment that's going to go on here, and so yeah, hopefully you guys are ready for some of the volatility that's going to be coming up ahead. So let's now move to the technical side of things and see where everything is transpiring here today. So if we look here, we'll start off, I guess we'll just go right to the Bitcoin chart here. Hold on, let me do one thing real quick. I just got to pause this real quick here from Bloomberg, and then we'll move on. All right, so let's take a look at the Bitcoin chart here. We'll lead off with this because this is just more of just a risk assets here, and technically it looks pretty clean here. Obviously, we've got the nice top that's been put in. We've had this 89,150 resistance level. It failed through here in early March here, and then retested 2 times here so far. Here we can see on March 24th, and then another test on April 1. So this is now back into this upper trend line band, and so we're going to look for this move to come out of here. If we really start to break down in overall global risk assets, we're going to expect Bitcoin to follow suit as well. And we've updated our charts here in regards to the micro strategy MSTR or strategy B now it's called. They're a Bitcoin company that we follow every day, the data, and their break-even price is down here 67,458. So we get through this level here around 80,000. Um, Down to this level here, we should expect things to start to accelerate and get us back into this overall resistance level that was the resistance for quite some time. So Bitcoin is just following the other assets down as well today. So let's look at the next one. We'll take a look at the triple Qs. And this one's a really clean technical chart here. Let me just zoom in and see kind of what we're looking at here. This triangle wedge, long-term, 2-year in the making wedge here that we finally broke down from. And now you guys have known that that 500 area, 505 basically is now longer term resistance. 477 was kind of our bull bear pivot now, and we've now tested it and got below it, tested it, and now failed again as the triple Qs are down at 454 now. So honestly, this is a nice breakdown. Overall, big term, long term top is put in here, and we will expect a battle going on always because everyone's long only equities all the time. Constant inflow, 401k money, constant inflow of buyers consistently, but as things turn, it's going to be interesting because they're going to keep buying lower and lower prices until we eventually get a nice move down. So right now, our target's 413 area. And we should get here at some point here, considering the breakdown now in this overall topping method. We're not down really that much, but you know, people are thinking like, okay, we're down 4.5% today. Well, overall, if the big scheme of things, when you look at it from 2023 to where we are now, you know, this is just a big term, long-term top. So we're not really down that much. This is just a readjustment period. Who knows how far we're going to readjust. We think the real value area is somewhere down here, and so we would much rather be comfortable with selling pops here now in overall risk assets and equity structures in general. As time moves on, we suspect that people that continue to buy new lows will eventually start to bail and start to sell, and that's when we'll get the finally a bottoming out and consolidation. But for now, technically, you can see on the triple Q ETF, the longer term top is kind of in place here, and we're just going to you know say that the trend is now lower. And let's see what else. In regards to everything's not a bloodbath today. Obviously, risk assets are, but if you look at the bond market, the U.S. bond market here, we'll take a look at the 30-year, even though it's not the biggest recipient of the monetary flows today, although the front end is the big recipient, shorter term notes and T-bills, things like that. Let's just say for now, the bond market is threatening the bottom of the, you know, we get to 440 area, we're going to start to threaten this upward channel here, and this is on the daily. If we looked on the weekly, obviously it'd be a much bigger, give us a much bigger time frame to look at, but we're going to look at on the daily here and just see this uptrend that's been in place since 2020, and we are under threat of breaking through this if we get you know, below 4.30% in the 30-year. So this is obviously the Fed can't really control the long end, but obviously it's going to be a recipient as risk assets start to fall. The 30-year will start to come down, but this is going to require the Fed to start cutting rates, and then if they start doing that, then the 30-year can drop even more, because if the Fed's going to start to cut rates, then the front end is going to start to front run that. And when we talk about the front end, we want to look at the 2-year, and you can see on the daily chart here, this is the 2-year. You know, we've obviously been in a downward trend here, but this area is pretty important, this 355. It was the breakout level back here in September of 2022. We retested it back down in March of 2023, and then retested it here again in September of 24. And now we're going to be retesting it here, it looks like, on our way there, because the 2 years 3.72%, so another 17 or so basis points, and we'll get to this level here. So we'll expect a test of this 3.55 again. How it reacts here, it's going to take some bad economic data to come in to get us below here. Most likely we're waiting for that negative non-farm payroll report, and then we'll see this 2-year dip below here. But for now, we would expect a sellers in the 2-year if it came back here again initially, but ultimately we expect it to crash through and the bond market to force the Fed's hand and start to cut rates. Overall, when we look at the 10-year, it's kind of our good proxy here overall of where, you know, the U.S. yields are, And you guys have known that we've talked about this 4.37% level for quite some time, respected it here, and back into the downward channel that we suspect will govern this thing for the rest of the year, assuming the tariffs filter their way through, assuming that risk assets continue to fall. We'll expect the government 10-year yield here to filter down and get ultimately, we believe, below this 3.5% once the Fed starts their rate cutting acceleration here as risk assets fall. And so this will be our target here now with our resistance. We'll still continue to be 4.37% in the yields, but we're going to expect this 10-year to continue to maintain this trajectory lower. Let's move over to the equities now. So let's just take a look at the S&P 500 futures here. So let me just zoom some of this out so we can get a little tighter look at where we're at. We love this Fib 618 level. We'll suspect this is going to stop the selling for today at the 54.45, 54.50 area. What is the low there that we got to today? Right there, 54.55. We're bouncing a little bit, and we should expect technical buyers here. So we're not going to expect them to push through here today. We don't think, even though coming into late in the day, we're not going to suspect that they're going to come in here and push this even lower without some technical buyers stepping in here at these levels. So this is the long-term buy support area. We're going to expect buyers in here for now until they can get us maybe not just a daily close below 45, sorry, 54.45, but a weekly close. But we are looking, take a look at this downward trend channel. We're going to expect buyers to come in here and start to step in and support this market here as the market readjusts and consolidates. And we'll expect the bull bear pivot line to be tested once again and then maybe possibly resume. So this is our kind of our trend where we think the risk assets will kind of continue in, assuming that the market is going to stay under pressure. But the S&P, down 4% today, and it's not looking good for the bulls here at all. But they do have some technical support here today, as we're showing here in our the bulls and bears will battle around this long-term buy support area. When we look at the Nasdaq futures, we talked about this 19,150 area, and they did support it. You can see here back to back to back days, but then the tariffs come and then forget it. Now we're back below it. It's going to be our initial resistance now on the upside, but and as time moves forward, we'll move the sell area and bull bear pivot down, probably get here around the 19,800 area. This will move down here, and so will the longer term resistance sell area as well. So as we start to retreat in these markets and they've broken through this long-term uptrend, we're now going to be back kind of looking at if we go here, let's just do it like a little parallel channel, kind of see what we're kind of looking at in regards to the overall trend that we should be following here for the foreseeable future. Now, everything's not certain. This is just kind of, what we're kind of seeing in regards to how we would look at this. But we do believe a longer term top is in play here. This is a longer term top that's been built. And now we're going to see sell pressure come in no matter what kind of buying is going on the retail side. And especially if we start to see unemployment start to uptick, non-farm payrolls go negative, this is going to collapse back down. So we are suspecting that this is in a longer term sell, and risk assets are going to continue to be under pressure. So when we look at on a bigger, little longer term time frame, we'll clear some of this out. Here's our longer term uptrend line. We do suspect to get to this level. So this 17,950 area we do suspect to get to. But even then, guys, this is a long-term top. We should collapse down ultimately down here in this long-term value area. If Trump's serious about realigning U.S. interests and bringing things back, this is going to be a major adjustment period. This is a new monetary system that we're going to move into. And we often hear about how the market's losing value. It's people are getting killed. No, this is all unrealized, guys. Realized profits is when you have realized monetary, um, uh, incentive. If you don't sell here, you're not. It's all unrealized. So until you sell, then it's realized. But if you don't take profits up here, then you don't have realized wealth. This is all phantom. This whole move from 2023, if you stayed long and you're up, from 12,000 to let's say 20,000, you're up 80, 80%. If you don't sell any of this, it's phantom wealth. So we don't want to hear that the market's losing out. Nobody's losing out here. It's This is wealth that was not realized or was not capitalized upon. So unless it was capitalized on, which some of this selling will probably most likely be, then it'll still be realized wealth. But if you were just starting out and buying up here at the very top, knowing all the fundamental and economic backdrops that we're running into, well, then we hate to say it, you deserve to get hammered because this is just a wrong location. There's, people always say I'm in it for the long run. Well, okay, you've been in it for the long run, but this is 2023 to 2025, right? The 2-year uptrend. Were you in it from the long run here from November 21 down to November 22 when it dropped, 40% or 30%? So, this is something that you kind of need to realize when you're trading and investing. Like, is it realized or unrealized? And so we don't want to lose focus of kind of the longer term trends, because if we are changing, then it's going to be a lot harder to stay long and make money if we are indeed changing. And we do think we're changing because the monetary system is going to have to readjust. And when we adjust monetary systems, and we have that, globally systemic volatility, then things in risk asset land are always going to readjust. The biggest loser here we're looking at is both the Russell. Let's take a look at that. Russell 2000 and the Nikkei. So even the Russell 2000, we don't have support here until down here. So what is that? Another 20% or so. So keep an eye on kind of the longer term picture, guys. We're putting in a longer term major top, and we don't want you guys to be lulled to sleep saying that we're just gonna resume everything back up. No, the economic fundamental backdrop's not saying that at all. This is a major implication of what the Trump is saying by just even using the term Liberation Day. That in of itself should give the rest of the world notice. We know the Nikkei is noticing, and even the Nikkei, you know, it's it's right at 34,000. It's just kind of funny. We've had this line there forever. You can see it was the top here, June of 23, busted out here in Jan of 24, tested it briefly here, and then back up. This was what the dollar carry, yen carry trade blow up, and then retested it, and then we went back up, and now we're right at 34,000. So this also is a long-term top once again, and this shouldn't surprise anybody here. What are we going to do? We're going to put in a Head and Shoulders and drip back down to here, but ultimately, it's still an uptrend. It's still in a nice uptrend. Let's just say here's our longer term trend. Hasn't broken anything yet. So there is room for the bulls, and obviously, overall things could adjust, and maybe the Nikkei comes out ahead. But ultimately, you wouldn't want to be long here. And I don't, short term, yeah, traders, yeah, maybe you might want to take a shot. But overall, guys, the writing's on the wall, and we hate to say it. One of the beneficiaries of this readjustment has been the DAX. Even though the U.S. has been the recipient of capital appreciation for so long at the sacrifice of the rest of the global economies, we've started to see a change here with the DAX. This is the futures now, but even the DAX future is pushing down to one of our support levels and breaking below. So overall, we do suspect the DAX will be under fire along with the rest of the risk assets, but it should outperform the U.S. assets because what we're going to see is a lot of repatriation out of the global investors, and that's going to move money out of the U.S., move the U.S. dollar down, and cause this is the readjustment that we're talking about. So this should outperform overall vis-a-vis U.S. assets. So keep an eye on that. As far as the dollar today, that's getting hammered, almost down 2%. But guys, it's not a big deal. Look at this here. We're not really haven't gone much of anywhere, but between 101 and 105 here. So 4% area of band until we start to break down. The U.S. dollar needs to really, this has been in a decent uptrend channel for quite some time. So unless we get below, say, 94 here, we're not really going to worry too much. But the risk is down to here. So can we lose another 20% of the dollar? Yeah, we definitely can. Um, at least 10%, sorry, not 20%, 10% down till we get to some supports here. So not going to shock us if we do that. So let's keep an eye on that. But definitely FX land is the beneficiary here as the U.S. dollar is going to move down in value here versus the global currencies. What else do we have over here that we wanted to take a look at? You can see the metals are getting crushed here. Crude is getting crushed. Let's take a look at crude oil real quick. This is the weekly, so maybe we want to tighten it up to the daily. But no, the weekly's okay. Let's take a look here. We've had these lines up for quite some time. You can see this is our bull bear pivot. This is our support. And it's going to hold here at this 66 bucks. So until we get below here, guys, we're not going to really panic and say crude's going to collapse here because we should expect buyers here. We've had buyers here for how many, for how long? How many years have we had buyers at these levels? So we don't suspect this to change materially unless we get a weekly close below here and then a test and another back test of it and rejection. But for now, we would expect the bulls to continue here in oil until the $66 level gives away. Um, yeah, RBOB is just getting hammered too, but it's all tied here to the these assets coming down. So you got metals moving lower as well. Nice move here in gold today. Gold's been real strong, but as we talked about, let's move to the daily. As we talked about here, break out of this long-term uptrend channel that we have was inevitable. And we got it, but we've got the back test now to it. So if this is real selling, and this is a bearish engulfer pattern, so we do suspect this is real selling going on here, not just profit taking. These are real sellers stepping in here as well. But it's going to be a battle because with the new monetary system, we know gold is going to be a big proponent of that or component of that. And so it's going to be tough to value this appropriately. But we'll suspect that bulls will still be in control here, guys. There's just some selling going on and some profit taking. But unless we get back into this trend channel here, even though it'll still be an overall long-term uptrend, we'll say the bulls are still in control until we get, let's just say, I would say the bulls are in control above 3,000. So let's just see how this pans out here. But definitely some groups are selling to raise capital here, which is what happens, guys, when risk assets move lower. We got to raise and sell. We got to raise capital and sell whatever we can. So this is what's going on here in gold. And silver down almost 7.6%. And we've highlighted this level. You guys have seen this. This shouldn't shock any MTR listeners or readers. We've highlighted this 35 buck area. We got a brief little move out, but then of it on a daily above 35 bucks, and then total rejection and failure out. So we suspect this will transpire into all the rest of the metals as well, as they're all kind of spread product against one another. We're going to see them all kind of move in tandem. And these have been big trades that have been, we've been, the CTA side market sentiment that our subscribers get have known that these have been in a long sentiment for quite some time. Even in copper here, a big uptrend resistance area is now respected once again. So we don't mess with these kind of moves. This is telling us that the real sellers are stepping in here once again, and that the buyers will be under pressure. Anybody buying up here is probably going to get it put in their face. So be careful there if you're, long only metals guy. Prepare for to fight this battle because this is what kind of we're seeing here. Um, Before we move to like the Magna Libra Mega 8s that we keep track of for our subscribers, let's go down and just take a look at a couple of other things in regards to the futures. We love to look at this chart. This is the S&P 500 future versus the NASDAQ. We've been waiting for this bounce above this minus 125 level, and we've gotten it here. Obviously, nice bottom put in. This looks like you should, here's the thing about trading, guys. If you look at it from this perspective, you'll be like, oh, we're at a resistance area. Let's just say here. We're at a resistance area. We're going to get some selling here. Yeah, could the S&P 500 underperform the Nasdaq here and drift back down? Yes, it can. But overall, if we move out of this daily and we look at it from a weekly perspective, here's where the bigger picture that we're seeing. It's such a one-way trade for so many years. That this reversion is going to happen. It's bound to happen. This is even not even a real. This is just a nice bottom being put into place. We're going to expect the Nasdaq to underperform the S&P 500 over the next 2 years. So this is kind of what we're looking at here. And so we love to keep track of this spread because it all leads into the same narrative that we believe is going to transpire. And in regards to the bond market, here's your 10-year versus Fed funds. And you can see that we're starting to see us move back. The 10-year start to let's just take a look here, just because this is kind of hard to explain. This is the 10-year yield versus the federal funds rate yield. So the 10-year is starting to move away from where the federal funds is. So the federal funds at, let's say, 4.25%, with the 10-year at 4.05%, that's a 20 basis point negative spread. So basically, the bond market is trying to force the Fed to say, you guys are wrong. You need to cut rates, and we're going to drive short-term and mid-term rates down until this spread is far enough to where it's going to force your hand to cut Fed funds down to meet it. When they cut Fed funds, then obviously then this spread moves back towards positive because the short rate will move down and the 10-year rate will stay, let's just say, steady. So this will remove this negativity that we have here. Obviously got real negative here from plus 2.4 down to minus 1.7 or 1.70. And then now we've bounced here as the Fed started their initial rate cuts and brought the short-term Fed funds levels down. This spread, the 10s Fed funds, came back to basically just a little bit above even. And so now we're moving back down to a minus 20 basis points. So once the Fed starts to cut, then this will revert back this way. But the bond market's going to force their hand and drive 10-year yields lower, which will move this spread down more negative, and then the Fed will cut, and then this will move back up to this way, which will be the normal trajectory of things. And so that's what we're going to, expect to see here in regards to the yield curve. Magna Libra subscribers always get kind of information on that, the U.S. yield curves as well. Now let's move over to JP Morgan. We want to take a look at this stock real quick because I think it's coming up to some decent support here. So this is JP Morgan equity. Obviously, our longer term value area is lower. It's down here. But for now, this 226 area should be decent support. We start to get a close under here, guys, and we'll just say the longer term top is in. But we should just expect buyers here for initially, and it has stopped it today, it seems like. But we'll expect some back and fill here. But ultimately, we'll get back down into this value area, we believe, especially as rates and margins, net interest margin starts to constrict as the Federal Reserve starts to lower rates. This will hurt JPM stock once they start doing that. What else do we want to see? Okay, in regards to the Mega 8s, let's take a look at that, guys. Downward channel, obviously. This is part of the reason why we're kind of bearish on the NASDAQ as well. This failure here for the Mega 8s. Now, this is the top 8 largest market cap U.S. stocks. We swap Tesla in for AVGO, which is Broadcom sometimes, but because they battle out between the 8 and 9 spot. But right now, this chart here has Tesla within it, and it's pushing the lower boundary here. But we'll suspect that this has been in a downward trend channel since the end of January. So obviously negative bias here on the Mega 8s moving forward. And guys, this is getting pretty long here, but we're going to wrap it up with this. This is that 10-year versus Fed funds. We were just talking about that. This is that negative carry. And what you want to do is take a look at this historically and see how in the, these negative carry times, which are denoted by these red bars, what happened to risk assets during those times of post period past these negative carries when the Fed funds started to get cut and risk assets started to get repriced. We have it here right before 2000. We have it here right before 2008. And we've had almost 3 years. 2024 did make it out because the Fed started cutting before the end of the year, but this is unprecedented, guys. So when people tell you that assets aren't overvalued, we're going to just tell you that by this discounting method here, there's some major mean reversion en route. So be careful out there. All right, that's it, guys. We'll be back with more later.